Hello, Max. How's it going?
Things are going well. Hello, everyone.
Awesome. I think that this is a perfect segue again from inventory management and how it affects cash flow. Now we're going to talk about financing options so that we can increase cash flow and when to invest in financing and how to grow the store off the backbone of leveraging maybe the best thing to leverage other people's money.
Right.
Max, I will let you introduce yourself and talk a little bit about Brex. Guys, I'm really bullish on Brex. I've reviewed them as well. I'll link to that in a second. I'll link to our special offer that we have with Brex so that you can get a great deal on something that literally costs no money at all. They will give you cash back and they will even give you a signing bonus if you meet their qualification criteria. But I'll let Max talk about that and talk about financing options. So go for it, Max.
Thanks so much for the intro, Derek. And I think you did a great job planning these sessions because what I'm going to talk about today, I think ties in very nicely to what Jill was covering, which is, there are a lot of moving pieces, especially this time of year when you're running an e-commerce business. And budgeting and cash flow and cash on hand is often the limiting factor to how much you can scale. So today we are going to talk about BREX'S, our e-commerce product, and particularly we're going to hit on the topic of how you should be financing your cash flow as a rapidly scaling e-commerce business, particularly this time of year. My name is Max Segall. I lead e-commerce at BREX'S. We are a corporate credit card company. We're founded a little bit over 2 years ago. The story of BREX'S is pretty interesting and contextualizes what we're doing. So I'll quickly hit that and then we'll dive into it. So we were founded by two Brazilian entrepreneurs. When they were 16, they started a company called Pagarme, and that was a payment processor in Brazil. They grew it very rapidly. By the time they were 18 years old, they were processing over $1.5 billion in annual transaction volume. They had over 150 employees and they were 18. So they wanted to go sell the business and go to college. So they sold it to a company called Stone, which you could think of as the Stripe of Brazil. And they started college, quickly got their next startup idea, dropped out, and they got Y Combinator funding. So they were a well-funded startup. The company had nothing to do with fintech or corporate credit cards, but they wanted to get a corporate credit card for their business because they were hiring some people and they wanted to let them spend on behalf of the company. And they were getting rejected left and right, because one, here they were with a company with no credit history. So nobody was willing to lend to them. And they were 18-year-old Brazilians with no US credit history. So they weren't even able to personally guarantee the card if they wanted to. And they just realized how broken the market was in the corporate credit card landscape and how underserved many pockets of the market are. Startups was the first vertical we went after, but very quickly we realized e-commerce was a much larger market that very similarly was just dramatically underserved by traditional corporate card options. To tell a little bit of the story. So Pedro and Enrique, they kind of grew up serving e-commerce businesses. They know the landscape well. E-commerce, these businesses aren't like startups. They're usually profitable. They don't raise big venture rounds up front because they could fund their operations with the cash flow they're generating. But that creates a little bit of an issue. You have the inventory to cash cycle. So you're purchasing a bunch of inventory. You might be investing in advertising. You're not actually seeing the cash on that investment until months after the fact. And so you have this several month gap, which creates a financing need inherent in the operations. And if you want to scale your business, the cash on hand, typically isn't sufficient to do so. E-commerce businesses also tend to be highly seasonal. Their, sales can be unpredictable. You don't know exactly how much investment you want to make ahead of a busy selling season. You don't know how much you're going to sell in that season. There are peaks and troughs. This time of year is kind of like, it's the critical point in the business's life cycle to really scale investment. You might not have the cash on hand to do so. And this kind of amplifies the inventory to cash problem that I just spoke to. And then finally, kind of when you look across the landscape of options to address this need, It historically hasn't been great for e-commerce companies. They're very difficult businesses to underwrite. They require kind of a nuanced understanding of the seasonality, the financial profile, the venture capital appetite for e-commerce in the early stages. One isn't necessarily as robust as it is for, software businesses or other businesses we come across. And two, it just might not be the best solution for you running your business. So when you think about financing your business, there are a couple of key questions that we find merchants are always trying to think through. There's the question of how much capital do you need? This time of year, everyone needs more budget, but defining exactly how much you need is a pretty difficult problem to solve. There's the question of kind of what kind of payment terms you like when paying back whatever financing option you're looking to take out. You probably need an extended period of time to really realize the return on whatever investment you're making this time of year. There's a really big question, which is fees. This is a nuanced question, but many of the financing options available to e-commerce merchants are really, really expensive, and the financing providers do a pretty good job of hiding the effective interest rates on the loan options that they offer. So it's something that you need to be really mindful of. Many merchants are just very desperate for the extra budget this time of year that they're willing to pay, a really high fee. But the fees can add up, and it's an important thing to keep top of mind. And then finally, there are other dimensions upon which a financing option can give you as the merchant flexibility. An important one is a lot of the above properties are fixed, but you might need something a little more flexible. And so there are certain dimensions which we'll get into in a bit, beyond kind of the traditional lenses that you're looking at financing options that you'll want to think about. This is just a quick overview of what the landscape looks like for some of the popular e-commerce financing tools out there. You have your traditional bank loans. These are typically pretty slow, laborious processes to go through, but you could go to a traditional brick and mortar bank, talk to them about taking out a loan. It typically takes a pretty long time to go through the application process. Then they take a while to review your application. They're going to charge you an interest rate, and many times you're going to need to personally guarantee the loan. But that's the old guard of financing options. You have kind of the e-commerce platforms that are starting to offer loan options or merchant cash advance options to their customers. So there's the Amazon Capital Loan, there's the Shopify Capital Loan, PayPal has a working capital loan. These companies are doing wonders in expediting the process between kind of when you recognize that there's a need for financing and when you actually get the cash to finance whatever investment you'd like to make. There are obviously trade-offs. No product is perfect. These products carry really high interest rates. And a lot of the time, the way that these vendors will kind of charge you interest is they'll say, okay, merchant X, looks like you're going to be scaling your operations. Do you want us to deposit $50,000 of cash in your account? Click one button, yes, they'll do it. And then the fine print will say, you just need to give us 3% of your sales until you pay us back $70,000. And if you take the time to calculate, the effective interest on that, it ends up being anywhere between 30 and, in some cases, even as high as like 90+%, which is incredibly expensive. But many merchants are just kind of very urgently in need of funding. And so they're willing to accept the high interest rates here. The other thing just to note is, these options are all popular. There is increasing demand for all of this. But a lot of the times these loans aren't giving merchants the kind of the quantum of funding that they really need to make the investments that they know will be best for their business. So a lot of these programs get capped out in the, call it 250K range. But you might be looking at your operations, and you might be saying to yourself, if I had $1 million to work with, I know I could make a really nice return on that. A lot of these options won't give you that, that limit flexibility. So just to quickly recap, there are some really good things about the short-term financing options on the e-commerce market. There's a lot of innovation in this space. They're generally, pretty fast to fund and flexible in usage. But a lot of them come with the requirement that the founder of the business personally guarantee the loan, or someone's credit score is being impacted by the use of this financing option. A lot of these options are limited to a specific platform. So a Shopify's capital loan, for example, is they're underwriting your business based on everything they're seeing on Shopify, but you might be selling elsewhere as well. And so your limit might not be as high as you as a business deserve, because Shopify doesn't have the full visibility into all the platforms you're selling across. And then the final con, just to highlight, is these are very, very expensive financing alternatives. And the interest rates are often hidden. We're a corporate card, but we offer businesses effectively the same end goal, which is a way to finance, the big investments they need to make. Traditionally, corporate cards have not been good for e-commerce. That's why we entered the e-commerce space, was we noticed there was a really large unmet need in this space. Corporate cards for e-commerce businesses are, they're limited because e-commerce businesses are different. They're harder to underwrite. So when Amex, or Capital One will look at your e-commerce business, they'll say, okay, this is a business that's very seasonal. It fluctuates in and out of profitability, maybe. It hasn't been around for a while. And so they're not able to give you a really high limit. Or if you want a high limit, someone's going to have to come in and personally guarantee the card. Both of these are not ideal scenarios. Corporate cards are also, they can be pretty expensive. So as soon as you kind of start spending beyond the end of your statement period, which is typically 30 days, you end up paying, double-digit plus annualized effective interest rates. And you typically need more than 30 days to pay back whatever investment you're making in a business. And, I've hit on this a few times before, but, the corporate card industry kind of treats what they consider the broad bucket of small business as one size fits all. That's not a great fit for e-commerce businesses. You shouldn't be underwritten as someone that's selling a product online in the same way that a restaurant is being underwritten. And so there are all sorts of issues that come with being lumped into kind of what, is thought of as like a, one size fits all corporate card for small business. So I want to spend some time talking about why we built our e-commerce product, what the value prop is. And we really, the product is built in such a way that we want to make it as easy as possible, as cheap and as cost effective as possible for you to fund your business. So what that means in practice is we're offering e-commerce businesses 60-day net payment terms with absolutely no interest. The net feature in our payment terms is an important distinction. So in practice, what that means is if you spend $5,000 on your BREX'S card today and $4,000 on your BREX'S card tomorrow, BREX'S is going to charge your linked bank account $5,000 60 days from now and $4,000 61 days from now. So you have a full 60 days to pay every transaction back. Why that's important is, even the financing options that say, we're giving you a 60-day period to pay back, it's typically on a statement period cycle. And what that means is if you're making a big purchase on day 57 of your 60-day statement period, you're only really getting 3 days of float to pay that back, because then your statement period ends and you're faced with the decision to either paying interest on the outstanding balance or pay it down in full, and you're not getting the benefit of the extended float. We're giving you a full 60 days to pay whatever transaction you make on BREX'S back with no interest. There's no personal guarantee. We're underwriting the businesses fundamentally. We're underwriting businesses, and I'll get to this in a bit, based on kind of the best leading indicators of an e-commerce business's success. So that enables us to issue a card with a really high limit, and no one's on the hook. So if you start using your BREX'S card, you start prepaying it, you start maxing out your limit, no one's personal credit score is getting impacted at all by this. We're underwriting the business fundamentally. We're giving the highest limits on the market, and we're able to do that by looking across every platform you're selling on and underwriting you based on your consolidated monthly sales volume. So we look at what your cross-platform monthly sales volume is, and we're giving you a limit that's anywhere between 50 and 100% of that number. So we have plenty of businesses that are selling millions a month online, cross-platform, and they have multi-million-dollar limits with BREX'S that they're able to float 60 days completely interest-free up to. We have a set of really cool expense management features built in behind the card. So BREX'S is more than a card. For those of you that are already BREX'S customers, you might know there's a BREX'S dashboard. We classify every transaction you make on BREX'S in a really granular way. You can map our classifications to your QuickBooks ledger items, to your Xero, NetSuite ledger items. We capture the receipt in real time and then sync everything over to whatever accounting software platform you're using. So it ends up saving you a ton of time at the end of the month, kind of reconciling and closing the books. It either saves you a lot of time, or in many cases, it saves your bookkeeper a lot of time. So accountants love it when their customers switch to BREX'S, and I'm sure, if any of you end up signing up after the call, your accountant will thank you. And then finally, we have a rewards program that's built for e-commerce companies. So we're able to offer up to 1.5% back, completely uncapped on every dollar you spend on BREX'S. I could get into the nuance of how that works during the Q&A portion, if that's what people would like to talk about. And then we have discounts with over 20 vendors that are relevant for what all of our e-commerce customers are spending money on. An example of that is Klaviyo offers every BREX'S customer 15% off for their first 6 months on Klaviyo. Forder, the fraud prevention tool, is offering every BREX'S customer 50% off for their first 2 months on Forder. So we have deals like that with a lot of relevant vendors for e-commerce merchants. And if you add kind of the dollars saved from all of these discounts together, it's well over $50,000 in value that you just get for free by being a BREX'S customer. So we launched this product in February. It's by far the fastest growing part of our business. There are a lot of big brands that are using BREX'S, companies like Untuckit, Perfect Keto, Kuyana, Hims, Greats. There are a lot of companies that are finding this product really valuable. The combination of the high limit, extended float, and no personal guarantee, I think, are really what people are enticed by early on. But there are a lot of other cool features these companies love about BREX'S as well. I want to spend a few minutes just syncing with everyone here on what we look at when we're underwriting e-commerce businesses. So what our underwriting team needs to see in order to approve an e-commerce company on BREX'S. And these are the underwriting requirements today. We're always working to improve the flexibility with which we look at businesses. Underwriting is a core competency for BREX'S, and so we want to be kind of the best by far in the market in this capacity. We need to see a business that has, across all platforms, 100K in monthly sales. On top of that, we need to see year-over-year growth in the most recent month. We need to see a business that has a US EIN and a US business address. The business needs to be in operation for 1 full year. And then the final underwriting criteria is we need the business to have a positive net cash balance in a linked bank account. So a part of the BREX'S application is you link your bank account online. It takes literally seconds. As long as you have a positive net cash balance or cash net of all debt liabilities, we can approve you on BREX'S. And then, what we've arranged with Derek, we love this community. We want to really make sure that members of this community are getting great value when they sign up for BREX'S. So if you sign up for BREX'S at brex.com/ecommerce tech, or if you just email us directly at ecommercetech@brex.com, we'll make sure that you're underwritten and onboarded in a priority way, and that you get a $500 sign-up bonus and waive card fees for life. So for anyone who signs up through either of these means, BREX'S will be completely free for your life on the card. It's worth noting the only fee that BREX'S does charge our customers is a $5 per user per month fee for any customer that has more than 5 cards outstanding. We'll waive that for anyone who signs up through either of these channels.
That is awesome.
Yeah, I mean, that's kind of it. I think the last thing to hit on is, companies are spending, if you kind of look at the breakdown of where companies in the e-commerce space are spending on BREX'S, you see a lot of ads and just broad marketing spend. It's probably going to continue being the most popular category, especially this time of year. Lots of Facebook, Google ads, Snapchat, Pinterest as well. A lot of people spend on shipping, inventory, across the board. Anyone who accepts a MasterCard, can accept BREX'S, and there are no foreign transaction fees.
Love it. Awesome. So the only one competitive point that other cards have on you is the question that William asked us in chat, which is it's the cashback amount. So, and you said up to 1.5%, and I thought it was only 1. So it looks like you're getting higher and higher every day. But I've heard people talk about their card having 2% or 3% cash back. And that is one of I think the harder, if they're getting more cash back and they don't need the cash flow, then they don't tend to move over. How do you combat that? Or maybe when is it a better fit than worrying about cash?
Yeah, sure. So couple things to hit here. One is, the companies we're finding that want the maximum float, prioritize float over cash back. And so that's the dimension that we're optimizing in for those customers. But we recognize that cash back is important. And so for companies that would like to earn cash back on their e-commerce card, we can give them 30-day terms and give them 1% back uncapped. Or if they really want to maximize cash back and they don't care much about the extended float, we could give them net 5-day terms and 1.5% cash back uncapped. There's a very important distinction here because a lot of people will come to us and say, well, Amex is giving me 2% back. So the reason why you would use, if you were a cashback optimizer, and the reason why you would use BREX'S over that offering is, twofold. One, Amex will often give you a cap above which they no longer offer cashback. BREX'S is offering the highest limits on the market. So your limit with BREX'S will be orders of magnitude higher than what Amex is giving you. And you're getting cash back completely uncapped. You can spend all the way up to your limit. You're still getting cash back on that last dollar all the way up to the limit. So the aggregate amount of cash back is greater. And then the points on Amex aren't worth a full penny. So Amex will tell you might be earning two points on every dollar, but that's not a true 2% cash back. It's closer to 1% and change cash back because points are a little sneakier. Our
points, and from what I understand, you just put the money straight in the account, right?
So you could do 3 things with the cash back you're earning. You can use it against your statement balance, so just pure cash value. You could book travel. We have a built-in integration with a travel booking tool, so you could book travel, hotels, and airlines in BREX'S, and you could use the cash back value for that, dollar for dollar. Or you could actually, we just launched a really cool feature where you, as the admin of the BREX'S account, can transfer the points you're earning cash back to anyone at the company's personal mileage account. So if you're the admin, you could take all the miles for yourself. You could also let every employee kind of use the miles toward their own personal mileage accounts. And that's just a cool feature that a lot of our customers were demanding.
That's really